All of them?
Not all, a lot of them. Like, yeah, I was lucky because I was at home. It's really quiet when I watched them, so I had headphones the whole hour. It was challenging. But yeah, the last topic, all of them, I think.
All of them. All right.
Was it the first one?
The first one was really bad.
Oh, that was last week's.
That was like,
This week?
yeah,
Was that the Westmont volume?
yeah, because I wanted to sort of do it in order.
Yeah.
And that was the first one up, and I was just like, oh, I couldn't.
I listened to it, but with headphones, like listening with a lot of concentration.
Right, okay.
But I was in home where it's really quiet, which probably helps.
Now, it's 8 o'clock, so we can start. Have a look at that paragraph in your book. Then have a look at 18330. So now you should bookmark that because it's a fully set franking account. So if you're sitting in the exam and you think, remember, there it is. Which book? 18387. And if you look at the pages before that, if you go to 18330, this is the area we're going to look at first today. If you move through it, so maximum franking credit on page 2074. Pages are so thin. And then 18350, benchmark rule. So the reason I'm pointing this out to you is that it's all here, okay? I'll never forget that we had to annul a student's mark because the student wrote a full franking account into the back of this book, and yet there was a full franking account in the book. So if you're not reading the book, you're doing yourself a disservice. Where is everyone today? Is there some big assignment due or something? Lord. So there's good forward planning here.
Oh, that's one.
Which one?
The statistics one where you have to do it by hand, right?
No, it'd be easy if you could do it by hand.
Oh, the Excel one?
Yeah.
Yeah. There's really good programs that do statistics for you.
All right. Okay, so
I think if we did, I could have done an SPSS in 5 seconds.
Fan Chow came but was sick and I sent her home.
What's his program?
You,
It's a statistics package
Jim,
that we used inside.
Poe, Rachel, Manuela. Okay, let's go. Well, pity them because today we're going to do franking accounts. And when you first look at franking accounts, they're confusing. When you've done a couple, they are so easy. And if you see them in the exam, you go, oh,
I'm doing that first.
thank you, thank you. It's almost like a guaranteed 10 marks or 12 marks, okay? But when we start, you're going to think, oh my God, what is this all about? If you've been following, excuse my weird attire today, but I'm going to make a light board lecture. So I have to wear something light, and I don't have any winter clothes that are light. So I have to wear summer clothes with a coat. Now, actually, if this light board works, I might do one for us on an exam question and see how that works. So I'm trying it as an introduction to another topic, another unit for Open University. So I'll see how I go. It's not too hard, you might have even more of me to look at. Now, if you've been following any of the election, even if you aren't an Australian resident, you'll know there's been a lot of talk about franking credits and refunds. Yeah? So today we're going to learn what that is all about. Now, if we go back in time, what used to happen was if a company made a profit of $100, it used to pay tax, and the tax rate at that time was 46%. Which meant that it paid 46% in tax, and then, good morning, it had $54 of after-tax income left. So then it paid that $54, so now we're looking at it at the shareholder level. It paid that as a cash dividend to the shareholder, so this was cash. Okay? The shareholder then had to pay tax on that money. And in those days, it was mainly people at the higher end of the tax bracket spectrum who owned shares. And the top tax rate at the time was 62%. So this person then paid tax of 32%. So eventually, the shareholder ended up with $22. So of that $100 dividend, $78 went in tax. Who wants to invest in a company? Right? It's very... it wasn't something that you really wanted to do because so much money went in tax. So then we came up with... Now, in this case, the dividend was highly taxed. In Hong Kong, for example, you don't pay tax on dividends. No tax at all. Because it's considered the company's paid the tax on the money and now it goes to the shareholders. And then you have sort of variations in between. Now, what came up after that was this idea of dividend imputation. I'm going to work with the 30% tax rate because it's just a bit easier. What happens now is the company tax rate has dropped significantly. So now the company's got $70 of after-tax income. And when it pays that $70 to the shareholder is imputed with the tax paid by the company. So the shareholder will include that $30 in taxable income. So now the taxable income is $100. So only receive cash of 70, but must include, so this is statutory income. If you've done any of your reconciliations, remember how we add back the franking credits? Because it's statutory income, it's not accounting income. There's a dog out there. I brought my dog in once when I came to get exam papers, and I got called up by a security guard. And he said, "You can't have a dog on campus." And I said, "Yeah, okay, all right, I won't bring him back again." And then he said, "You can't take it into the building. Your dog's a biological hazard."
What about the dog that they have that around here that...
Oh, George Bode. George is a therapy dog.
I had a lecturer who had a dog with her who told her when her blood sugars were low, and that dog was
Who what, sorry?
told her when her blood sugars were low because she couldn't recognise it anymore because she'd been diabetic since birth.
Oh, wow.
And that dog used to just run through the entire campus.
Yeah, but see,
Fluffy dog.
they're allowed. Mine wasn't. Anyway, so now you might think, oh, hang on, you've only got $70 in cash, but you've got to pay tax on $100. But if your shareholder is on the 19% tax bracket, your shareholder then gets a credit for that tax paid by the company. And in this case, the shareholder would get an $11 refund. So the tax that the company paid flows through to the shareholder. Now, this is where we're going back to, which is the Labor plan. When dividend imputation first came in, this shareholder would only have got a credit for $19, being the tax payable. And why it changed was people said, but hang on, I only paid tax at 19%, right? But you're effectively taxing my dividend at 30%, right? Because you're not giving me back the money. So a lot of people on lower incomes were really unhappy because they weren't getting the refunds on their franking credits. And so the law changed so that now, if you're here, you get this refund. And this is the big carry-on in the election, that now we're going back to the old rule. So, and the other thing is, now of course, you'll still pay Medicare levy on that. So you'll still pay Medicare levy on your $100, but you won't get it as a credit, and you can't use credits to offset Medicare levy. So, whether it's fair or not,
No, it really just basically disadvantages low-income earners, which makes no sense.
I'll tell you what, where it severely disadvantages older people who may have shares paying dividends, but they're not wealthy. Where I'll tell you where it's in superannuation funds. See, superannuation funds are only taxed at 15%. So you can imagine superannuation fund gets the $100, it's only paying tax at $15, but it's got a franking credit of $30. So those super funds are getting the refund. Now again, so like my mum's got a super fund like that. You know, it hasn't got a huge amount in it. She'll actually be okay because if you get a pension, you'll still get the credit. But if you've got people, say, who were small business owners all their lives, they've got a small super fund now with, I mean, even if you say $1 million, it's not a lot. If you're getting interest of 1%, or, you know, your shares aren't giving you a lot of money, and they will miss out because they've got too much to get a pension, but not enough to be really wealthy. And they're the ones who are feeling the mega super funds, you know, where they've got $10 million in them or whatever, they're getting the refunds. Right? And I reckon what you could do is put like a limit on it. You know, if you've got more than 3 million in assets or something, you don't get it back. But at the moment, unfortunately, and this is what happens with legislation, that's why I want you to learn to read legislation, because what it's doing is it's taking the old proverbial sledgehammer to crack open a very small nut. You know. So unfortunately, it's going to catch these people as well as these people. So it's interesting to see what will happen. All right. So that is where we're going. Now, of course, if you're not on the 19% tax bracket, what happens is if you're on 32.5, the company's paid 30% of your tax and you only pay the other 2.5. If you're on 37, you pay the other 7. If you're on 45, you pay the other 15. Okay? So now shares became attractive. People thought, oh yeah, I will invest. You know, this is pretty good because some of my tax is payable. Whereas up here, people didn't want to invest because so much of the $100 of profit went in tax. Okay? So that's where we were. This is where we are now, and presumably we'll get some changes to come. But at least now you understand the rationale behind it. Okay? So that's what we're going to do today. We're going to do dividend imputation. We impute the tax paid by the company to the shareholder. Okay? So that's really simple. And as I said, some of you have come in late, and I said, for those of you who were here earlier, I said, franking accounts are difficult to start with. Do 3 of them, and they're so easy. Okay? Now, the thing is, let me get rid of this. This is a really nice little example, isn't it? You know, we pay, the company makes $100 profit, pays $30 tax, has $70 left. That would be really good, but of course companies don't make $100 profit. They might make, you know, 85,347,000, okay? As you know from doing reconciliations, there is a difference between what is your tax position and what is your cash position, right? So the company might be sitting there with all this cash that it wants to pay a dividend, wants to use to pay dividends, right? But how much tax has it paid? So to work that out, we have to keep a franking account. Now, if you remember nothing, remember this. And if you do, then the franking account becomes really easy. A franking account records the tax paid by a company. So every time company pays tax, the account goes up. Sounds weird, doesn't it? You pay tax, but your account goes up. And every time the company gives that tax away, right, by way of franking credits, the account goes down. So paying tax is a credit. Sounds weird, doesn't it?
It's just like I look at it like it's collecting franking credits by paying tax. So
Yeah.
it's kind of like,
Yeah.
so it's collecting those credits and then it's giving it away.
That's right. Yeah. But it sounds, people get confused because they think it should be paying tax as a debit.
Yeah.
You don't see paying tax as a credit. But it's a credit because the account is recording the tax you pay. It's like your bank account, you know. Well, you don't know because you don't go to the bank and deposit money. But in the old days, when I was young and you got paid, you know, you gave your money into the bank and your account went up. So here you pay your tax to the tax office and your account goes up. Okay? So how do we know what is a debit and what is a credit? And so for this, we look at our legislation. Now, those of you who came in late, I have suggested that you bookmark 18387. Ty, it's at the back of the book. 18, it's your commentary. Look down at the bottom for the paragraph reference. Look at the bottom of the page. Look at the bottom of the page. That's 11. So we're looking for 18. 387. Okay, 18387. Now here is a full franking account. What's that, Vince? Looking to see what else. 25. Now, okay, so that's a really nice set out franking account for you. We're now going to look at franking credits and franking debits. So the section is 205-15. Oops, no, I don't want to do debits. I want to do credits. 205.15, if only I could follow my own instructions. I'd be dangerous. Now, these are our credits. So we're in 205.15. And again, you'll find these explained in the back of your book as well. Okay? But this is the legislation. Now, it says the entity pays a pay-as-you-go instalment and satisfies residency. We're only looking at resident companies. Okay? Then, the part of the payment that is, well, the payment is a franking credit on the day the payment is made. So you pay an instalment of tax, franking credit. Joan, review.
No,
Is that right? Okay. Next one, the entity actually pays income tax. So you know you pay instalments, 4 instalments over the year, and then at the end of the year you lodge a tax return and you pay income tax or you get a refund. Or you've never been on instalments and you pay your income tax. You pay income tax, you've got a franking credit. Or a franked distribution is paid to the entity, so our company receives a dividend from another company, which is franked. The franking credit on that dividend on the day that the payment was made. So you get a franked dividend from another company, and that has tax payable. That's got franking credits. Those franking credits now flow to the recipient company. And 4 is a tricky little one when the franking credit's flowing indirectly through to our company and it's coming through a partnership or a trust. And the timing, this is the trick. It says, as specified in subsection 2, when you look at subsection 2, it says 30th of June. That just makes that the date of the payment. And if the company incurs a liability to pay franking deficit tax, the amount of that liability. Okay, those are our franking credits. If we then go to the 205.30 for our franking debits, so the debit is when we're giving away those credits. The entity franks a dividend, so it's the amount of the franking credit on the day the distribution's made. 2, the entity receives a refund of income tax, that part of the refund, so the amount of the refund on the date it's received. Ignore 2A and go to 3. A franking debit arises for the entity when the entity franks a distribution in contravention of the benchmark rule. The franking debit worked out under a specific paragraph, which we're going to look at. So every time you pay tax, the amount of tax is a credit. You get franked credits from another entity, that's a franking credit. And every time you pay those dividends, you pay a dividend, the franking credits you attach are debits. You get a refund of tax. Well, obviously, if you've been paying instalments, you've paid 1 instalment, 2, 3, 4 instalments, you lodge your tax return and you get a refund. So the refund is a debit. So remember, recording our tax payable. We shouldn't have paid $10,000, we should only have paid 9. So we've got credits for 10, we get a debit for 1. Make sense? Manuela?
Trying to follow.
Yeah. Remember, our franking account records the tax the company paid. Yeah? So in our franking account, and we're going to do a franking account in a minute, we have the date, the item, we have a debit, a credit, and the balance. Yeah? And if you think about it, we paid an instalment of $2,500, so our account went up. We paid another instalment of $2,500, our account's gone up. It's now got a credit of $5,000. Yeah? Pays a third instalment. and a fourth instalment. It lodges its tax return. The tax is actually only $9,000. So when the tax return is lodged, the tax payable is only $9,000. Yeah? So we get a debit. This is our debit of $1,000 because our company gets a refund. If we're recording the tax paid, we've paid too much tax, haven't we? Right? So when we get our refund, that's a debit. Okay? All right. Especially when we have a nice little class like this, if you've got any questions or if what I'm saying doesn't make sense, just say, explain it again. Okay? It's easier to do with a small class. So now we're going to learn how to record or to keep a franking account. And this is when we're going to do this question here, giggles. Now, this is your setting out for a franking account. And it has to be in chronological order. It has to be in chronological order. So it has to be date, the item, paid instalment, paid income tax, received frank dividend. Then is it a debit, is it a credit? And you have to maintain a balance, a running balance. Now, why do you maintain a running balance? Because the directors come to you and say, we want to pay a dividend of, $32,400,000. How many credits have we got? So you need to know what your balance is. Now, as you'll see later, we can go into debit during the year as long as we don't finish the year in debit. Okay? So we might know, oh, look, we've got 2 more instalments to pay this year, so we know we can fully frank our dividend because by the time we come to the end of the year, we will have more than paid the credits. Okay? So you can go into debit during the year, you just don't want to finish the year in deficit. Okay. So let's look at giggles. Now, I haven't put everything into chronological order, so you'll have to work out what goes where. So we've got July, we've got that very important date in November, but we've got October, December, February, so we have to go into chronological order. So I will get rid of this. Did I give you an opening balance? I don't think so. Yeah, so we have no opening balance. So usually, if you had a credit balance last year, you'd have an opening balance. So our first payment is on the 28th of July, and we're paying an instalment. And is that a debit or a credit? Manuela, is it a debit or a credit?
Which one? Is one pay credit?
Yes, because we're recording the tax we pay. So it will be a credit. So put in the date. or instalment paid?
So we just start from here, we're not doing it from each one.
No, we are doing it in chronological order. That's what I said to you.
Okay.
Because nothing else has happened in July.
Won't February be?
No, because it's financial.
It's a financial
Oh,
year.
financial year. Oh, it's done. I'm glad I made a mistake. I remember.
Okay, so we pay an instalment, and an instalment is credit. So here's our credit, and our balance is now $30,000. The next item is, I haven't got my answer up, so I don't know. Sorry? 1st of October. And we receive a dividend. And it's only franked to 20%. Now, let's have a little digression because it'll make a bit more sense to us at this point. So you can see what we're doing in a franking account. All the way along, we're going to put in credits, debits. We're going to have a balance in here. Ty? Yeah? The thing is, as you know from reconciliations, that your taxable income position and your cash position, or even your accounting position, can be very different. Yeah? So when we did our reconciliations, you know, we might have gone from an accounting profit of $100,000 to taxable income of $150,000, or the other way. Might have been $75,000. So in many instances, what you have is, just to keep it simple, you might have $100,000 worth of cash. Georgia, can you not do any more? You might have $100,000 worth of cash, but your taxable income might only be $75,000 because you've had carry forward losses, because you've had Division 43 deductions. So your taxable income might be, let's keep our figures simple, 100,000, but our cash might be 200,000. If our taxable income is 100,000, our tax is only 30,000. 100 at 30%, 30% being the company tax rate. So if we look at our cash position, we pay our tax, and we've now got $170,000 left. So we want to give that to our shareholders. So if we give them $170,000, how many franking credits can we attach to it? So what we do is, so we go back now, and we look at
30 divided by 70 times.
our, I can never find these sections because they just never sit where I want them to sit.
Maximum is 85,000.
Where is, we need to find our maximum franking credit. Which I can't find. always wanted to be later. Oh, what did you say?
It says 255 on the thing. My notes.
Hang on. Let me go to 18. $202.60. We've not got 202.60 in the book. Okay, doesn't matter. Go to page 2074. Two oh two 2074, sorry. 202.60. Right. So this, it gives you the formula. The formula being the amount of the frankable distribution multiplied by 1 divided by the applicable gross up rate. Now, this is where it all gets complicated, but in the end, just use the figures as we show you. The corporate gross up rate is 100 minus the corporate tax rate divided by the corporate tax rate. And, you know, it could be 27.5. If you look at on the next page, 2075, entities that have a corporate tax rate of 27.5 will have a gross up rate of 72.5 divided by 27.5, and so on for the 30%. If you then, rather than take amount of the franked dividend times 1 divided by 2.6363 or 2333, if you look in our book, I thought they'd done it here, but maybe not. If you look in our book, or the simplest thing is 30 over 70, but you can't do that because technically speaking, it's not that. If you look at page 318 of your book, what you will end up doing is multiplying, if you're on the 30% rate, by 0.42857, and if it's on 27.5, 0.37931. So you might want to, actually now that I think about it, it would be quite good to put it into the company tax rates. So maybe where your company tax rates are, at the back of your book, my suggestion is, just to keep everything simple, is to put
30 divided by 70 and the other
It-
one is 20.
It's exactly that.
Yeah.
But because of the change, they've changed the formula. So strictly speaking, this is how you do it. But you get the same result if you multiply
30 divided by 70.
30 over 70 or 27.5 divided by 72.5.
And is that a percentage, the 0.4285?
No.
Just
Yeah, you just multiply it by. So if you went through and did this, 1 divided by applicable tax rate, then, so that's 1 divided by 2.333. If you did that, you'd get this figure here. So now the first thing we have to do is, when we decide that we want to pay this dividend to our shareholders, and you can see we've got a position in which we've got more cash, but our taxable income was quite low. If we want to pay this as a dividend, we have to say, well, what's the maximum we can give? What's the maximum we can attach? So if we multiply that, and what's it? That's the 0.42857. What figure does that give us?
72,857 decimal 1429.
So this is our maximum franking credit. So if we multiply that by that, and no,
12856.90. That's all right. Is that
well, you do the figure. What did you get, Tar?
70856.9?
Maybe because I used a full number instead of just that little. It is 72857 or 72856 point. So in
Just do this.
Yeah,
Just do this.
Yeah.
Okay.
So it's 6, it's not 7, it's 6. Instead of 7, 690.
So in exam, you just use that number
Use this figure.
instead of the.
That's the figure in the book.
Yeah, I listened to the lectures. I didn't try that, yeah. In the
But-
lectures, we did it the other way.
she's just said
Yeah,
that
I'll
this is
use
the way
that
we
now.
need to
Yeah.
do it.
Yeah.
I will use it.
Okay, 72856 points.
90.
Yeah, is that what everybody got? And just to tell you, this is what it's saying, right? 72. Remember I said it had $100, it had $30, it had $70 left? This is the equivalent. And if we multiply that out, what should we get up here?
One, two, 3, 8, 5, 6, 73.
Take 200. No, it's not quite right, is it? Oh, it's because they've changed it that little bit. Okay. 24. Is that right? 242. Yeah. So if you take 242856, oh yes, I'm trying to match back to that. Sorry. Yeah, that's why. Okay. So if you multiply that 242856.9 by 30%, just do that. what do you get?
72,85707.
Okay, and if you take that from that, what do you get? 170. So what it's saying is, we're forgetting about the cash. What we're saying is, okay, we've got cash of 170, so that's what we want to pay. The most we can attach to it in credits is 72,856, which sort of presumes that you've actually made that much. This is actually an irrelevant figure. All we know is that we can't pay more than this amount. So if we want to pay 170,000, we can't attach $80,000 worth of franking credits, because if we had actually paid tax on it, that's how much income we would have had to have paid that much tax to have 170,000 left. So we actually don't care about this figure. This figure is irrelevant. But what we're saying is, well, if we've got cash of 170, it assumes the most tax we paid to get there was 72. That's the most we can give in franking credits. So we can't give more than we've paid.
Sorry, can I say, so we always take it by the cash figure, not the tax?
No. I'm just saying cash is the cash you've got to pay. So the directors come and say, okay, we've got $170,000 cash,
Okay.
right? How many credits can we attach to it? Okay? Or they might have $10 million in cash, but they want to pay a dividend of $2 million. So they'll say, what is the maximum credit we can attach to the $2 million?
Yep.
And so you would then take your $2 million and multiply it by your 0.42857. It sort of presumes, therefore, that you've paid X amount of tax, but you can't give away more tax than you've paid. Right? And this becomes, obviously, you've probably paid a lot more, okay? But this is what you can attach to the dividend.
So we're working on the cash figure, not the taxable income figure?
Yeah. So you work on the dividend itself. Okay. So now, you can't ever give more than the tax you've paid. You calculate that by multiplying by the 0.42857. But you can pay less. And we know we're going to pay less here because even though we could, our maximum franking credit was what, 72 whatever? But we've only got $30,000 worth of franking credit sitting in our account. Okay? And this is why you will have what's called a partially franked dividend. So now we would say, if this was us now, we would say, well, we want to pay a dividend of $170,000, but we've only got $30,000 worth of credits in our franking account. So what percentage is that of what we could pay? And that's the percentage to which our dividend is franked. Okay, so now if you look at, so we've done maximum franking credit.
Sorry, but you did say that they quite often pay more if they know that it's at the start of it.
Oh yeah, you could, so in this case, we could frank it to 100%. We could frank it to 72-odd thousand. Because we know that we're going to pay another instalment or 2 instalments. Sharon, what are you doing? So the thing is, we have a maximum, but then we can decide on our own percentage. So in this case, we could pay the maximum if we knew we had more tax, more credits coming in. But let's say we're now at March. We're not going to have, or say it's April, you've paid your last instalment, the next instalment's going to be in the next financial year, so you've got no more tax coming in, you know you've got no more frank dividends coming in, so you say, well, that's it, that's all we've got. We have to pay 30%. Or 30%, 30,000. Okay? So what we have to do is we say, what is the percentage to which we franked it? We could have franked it to 72-odd thousand. We're only going to frank it to 30. What percentage is that?
I'm just wondering, is there a shareholder has a say of how much franking credits they want, or is it the
No.
company decide? So
Because the company's got to pay to everybody equally.
So if it doesn't, it decide not to give you any.
Well, it can't say you won't get any franking credits. It can say A-class shareholders will get X, B-class shareholders will get Y, but you'll see how we get around that, or how the Commissioner gets around that.
The
Okay.
international shareholders can't not get franking credits?
Yeah. So we're going to look at the benchmark franking rule. So the first thing that happens is, when you pay your first dividend for the year, if it's a private company, for 6 months, if you're a public company, whatever you do to your first dividend, whatever franking percentage you give your first dividend, you have to give all subsequent dividends. So that's your benchmark franking rule. Now, the reason for that is that before it came in, if your A-class shareholders were your taxable Australian shareholders, your B-class shareholders were your overseas shareholders, and your C-class shareholders were your non-taxable Australian shareholders. If you only had $30,000 worth of franking credits, but you had $170,000 worth of cash that you wanted to pay as a dividend, the only shareholders who get the most benefit from the 30,000 franking credits are the taxable Australian shareholders. So what they used to do was they'd distribute all the franking credits to the Class A shareholders. And then, oh dear, no franking credits left. How sad. Oh, now we'll declare our dividend to the Class B. Now we'll declare to Class C. And, you see non-resident shareholders, they can't use franking credits. They'd rather pay withholding tax. And if it's a treaty country, the withholding tax is 15%. Okay? So they'd rather pay 15% because they can use the 15% as a foreign tax credit in their countries. So they don't like franked dividends. The non-taxable Australian shareholder, well, the refund would be nice, but it doesn't matter. Okay? So until we had the benchmark franking rule, that's what used to happen. Now the benchmark franking rule says, whatever you do to one dividend, you must do to all subsequent dividends. So if you frank the first dividend to 30 out of 72, whatever that percentage is, you must use that same percentage for all subsequent dividends. So if you did that to the A's, then you do it to the B's and the C's. If you franked the A to 100, then you've got to frank the next to 100. Okay?
If you only have one class of shareholders, that's not a...
That's
thing.
irrelevant then.
So all they do
But-
is pay half
but-
the dividends and final year.
Yeah, but whatever percentage you give to that first dividend, then you must give to the next
To
dividend.
the final
Yeah.
year.
So if you only pay two dividends in a year, if you frank the first one to 80%, then you have to frank the second one to 80%.
So what you're saying is the franking percentage is an annual decision.
It's annual in a private company, and it's 6 monthly in a public company. There is a nice little concession for private companies which have until 4 months after the end of the year in which to decide their overall franking percentages. So they can issue a dividend today, they can issue one in 6 weeks' time, they can issue one in 6 months' time, as long as at the end of the year they've then got 4 months And then they can say, yeah, well, you know, what we should have done was frank them to 30% each or 80% each or whatever. We won't do that, okay? So in our questions, and look, you can be guaranteed, because I want to know, do you understand benchmark franking rule? There will be a first dividend, there will be a second dividend, which will be under or over franked, and there will be a third dividend, which will be under or over franked. That's how I can examine if you understand this. And this is what I'm saying. Do 3 franking accounts, you're home and hosed.
So if they're over-franked,
Then we'll talk about that in a minute. Okay. So here's our rule in 203.35.
could it be 203.50?
50. What's that say? Yeah, it is two. This book's been very weird. Right. Now, it says, it is 203.35, and what we're looking at now is the consequences of breaking the rule. So if you look at look at the book on page 2076, the franking percentage is the franking credit allocated to the distribution divided by the maximum franking credit. And then, so that section is missing. 203.35. That's interesting, isn't it? I'll just write them into the front of my book for the next edition. Now, what are the consequences if you breach that rule? The entity is liable to pay over-franking tax if the franking percentage exceeds the benchmark percentage, and franking debit arises if you under-frank. So franking additional tax is a penalty tax that you pay directly to the tax office. It doesn't come into the franking account in any way.
Sorry, that's if you overpay.
If you over-frank. So if you look at 203.50, look at 203.50. Got it? Everyone there? The entity is liable to pay over-franking tax imposed by the new business tax if the franking percentage for the distribution exceeds the entity's benchmark franking percentage. Exceeds. Look at the next one. A franking debit arises in the franking account if the franking percentage is less than the benchmark franking percentage. Okay. If you underfrank, it's a debit. If you overfrank, it's a penalty tax. So you pay a tax and you get no benefit for it. And if you underfrank, you've just lost a whole heap of credits. And your shareholders would not be very happy with you.
That's if you didn't pay the same percentage.
Correct, correct. So if your first dividend was 90% franked and your second dividend was 80% franked, you would have a franking debit. And it's essentially that amount of franking credits just gets thrown out of your franking account. Now, as a shareholder, you're saying, hang on, you could have given me those credits to reduce my tax payable. But instead, they've really just disappeared out of the account.
Why do they do that? Why would-
Because it's a penalty. These are the integrity measures. They don't want you under and over franking.
Yeah, so why would...
You wouldn't.
Yeah, okay.
In reality, you wouldn't.
So does it happen very often? Surely.
It did happen at the beginning when franking first came in. I can remember doing some work with a client who decided he didn't need to talk to the accountants about how much to frank the dividend. And I remember we're going back, oh God, when was I? Well, I've been here 30 years, so it was more than 30 years ago. It was 250,000. It was severe because it wasn't a huge company. So the thing is, it's like your parents say to you when you're young, if you come home after 11 o'clock, you'll be grounded for 3 weeks. So, if you do it, you get grounded for 3 weeks. And so then you say, well, why would you do it? Same thing. If you over-frank, you pay a penalty. If you under-frank, you lose your credits. So in the business sense, you wouldn't do it because your shareholders would be really unhappy with you if you did.
I was wondering, you know how we said with the installment it has to be the same every time?
Well, it doesn't have to be. It depends on how your instalments are paid.
Okay. No,
Yeah, because some companies will work on a percentage of the profit, of the turnover, and others will have a fixed amount.
Yeah.
So it's just like when it's the first one they pay.
No. That's just the instalments of tax.
Yeah. So I was
We're not
wondering-
talking about the instalments of tax. We're talking about when you pay a dividend.
Yeah. Oh, okay. Because I was thinking if that would affect the over and under.
No.
That's
It's
different.
so in our very first dividend. Let's keep our figures simple. Okay. Let's keep our figures simple. Our very first dividend, we're going to pay $70. We're paying tax at the 30% tax rate. So if we want to pay $70, what's the maximum franking credit that we can pay? So we multiply that by 0.42857. What do we get, please? $30, right? Okay, so this is our maximum franking credit. But we decide we are not going to pay $30. We are only going to attach franking credits of $20. We may not have $30. We may have cash of $70, but we may not have $30 worth of franking credits. So for whatever reason, we decide we're only going to pay $20. What was our maximum? 30. So what's our dividend franked to? 66.67.
So that's the percentage they're talking about. So it's not the percentage of profit, it's the percentage of the maximum franking.
Correct.
So
Now, okay, so now what it will say is we declare a dividend of $70 cash, which will be franked to 66.67%, which we know as $20.
Is there a common amount that dividends are franked to, or is it all over the
No.
place?
All over the place, whatever. I mean, so if you look at things like, say, National Australia Bank dividend statements, you'll find that they'll be partially franked. Why? Because they've got a lot of income, but it's come from overseas, so you've had foreign tax offsets that have reduced it. So while you've got lots of cash, your tax, your cash was 100,000, for simplicity's sake, but your taxable income was only 50,000. You know, there's this difference between your cash position and your taxable income position. If you look at companies that have subsidiaries overseas or branches overseas, the income coming back from those subsidiaries or those branches are what we call non-assessable, non-exempt income, which means we don't pay tax on them here. They've had tax paid overseas. We don't pay tax again here. Fabulous. You know, we don't pay tax at 30%. But what happens is we've got all the cash, so we pay it out as a dividend to our shareholders. Unfortunately, we haven't got enough franking credits to attach. So they come out as partially franked dividends. Who picks up the difference? The shareholder. So it's great. The reason that those areas were made non-assessable, non-exempt was to encourage their competitiveness overseas. But what it does is it shifts the taxing point from the company to the shareholder. And if your shareholder's up on 45%, 47% with Medicare, it's just shifted the whole tax burden onto the individual shareholder, not at the company level. So again, you see, people start to think, where do I want to invest? The big thing was Ireland, when Ireland dropped its company tax rate to 12.5%. Companies just went, bingo, into Ireland. Here we go. This is where we'll run our businesses. Suddenly, people are off the Irish social security system. Individuals are working and paying tax, right? And Ireland just went, you know, gangbusters, because companies said, well, if we only pay 12.5%, we can pay more to our shareholders. The benefit for Ireland was more employment, more tax collected, and it's a point missed.
And how sustainable was that? Sorry.
Well, they did go stupid. I mean, they built houses and apartments for people who didn't even live there.
So you can't just factually say, oh, gee, that's a wonderful thing.
No, but it went stupid. But that's why. Now, who was I talking? Who was giving a talk?
Was that unintended?
It was an unintended. It was people going stupid. Poe, did you go to Matthew Popham's talk? And that's what Matt talked about. He's an international tax expert. And, I mean, Ireland went completely stupid and then it just blew up. People shouldn't have been given money to build apartments for... You can't build $5 million apartments in a country that's only got 3 million people. Like, that was just stupid. But one of the reasons, and Matt talked about it in his session, is that if you drop your company tax rate, what you do is you encourage employment, and then you've got more people paying tax, people coming off social security, and then, you know, the flow-on effects of all that.
That's not a linear relationship either, though.
No, but it does benefit. I mean, you can see people... Yeah, but you can see companies that when they... Australia now has got the highest company, one of the highest company tax rates. If we make profit distributions to America, to the UK, we are hit with diverted profits tax. That's how out of line we are with other countries. So I'm not saying you've got to go to 12.5, but we are doing ourselves a disservice up at 30.
So now that taking that franking credit thing off, it's going to go worse?
Oh, I mean, you know, there will be people who will be affected, and some will be very wealthy people, and some will be not so wealthy people.
So basically, the company tax rate being lower can be good in a respect for the economy, but there needs to be a limit on to what goes on once that's happening.
Yeah, Ireland had great fun, and then eventually...
Where
after your
You can't mandate that limit though.
Yeah.
yeah, but you can look at
The time frame.
you can look at
No, you can manage it with interest rates.
sorry.
Are you going to tell me you can manage it with interest rates?
No.
Or anything like that?
No, but Ireland went, I think, too far. And the reason you could do the double Irish Dutch sandwich was because they had no withholding tax, they had all sorts of things. So, you can't go stupid because, yes, it built it up, but then, of course, it all crashed down and then you were probably worse off than where you were. Okay, but it does have benefits in doing it that way. But also, so who is it? Japan, I think, said, we'll drop your company tax rate providing you employ X number of people or X percentage depending on your entity. So what they said is, yeah, sure, we'll give you less tax, but then you've got to use the extra money to employ people. But if you're just going to take the extra money and then just distribute it out to your shareholders, then that's not what we want it to do. We want to cut your company tax rate so that you will employ people.
And so you invest back into Ireland.
Yeah, yeah. Right, so now, in this example, we've said we're only going to frank to 20, which is great, right? But every subsequent dividend, we must frank to 66.67%. In that year, we're only looking at a financial year. And if you're looking at a public company, every 6 months. Okay? Now, so what that means is that's Div 1. If we make Div 2, and we're going to attach the $30 franking credit, we've over-franked. And with Div 3, which is also $70, if we only frank it to $10, we've under-franked.
When you say we overframe it, the penalty goes straight to
The tax office.
So we're comparing from
To the
the
first
one,
dividend.
that's the comparison where it comes
So
from.
in the first dividend, when we went through, we said the maximum franking credit was 30. We decided to frank it to 20. And so we did the calculation which said, how much are you franking it over the maximum franking credit? Well, that's 66.67. Now, our second dividend, we're franking to $30. So we've done 30. Okay, that's the maximum. But how does it compare to this one? So this one was 66. This one is 100%. It should only be 66.67, so we've over-franked by 33.33, and that, you work out how to calculate it, is penalty you pay to the tax office. But this one, okay, we've only franked it to 33.33 instead of 66, so we've under-franked, so the under-franking will become our debit. So it's an integrity measure, and if you are on your job, you won't let it happen. But it's there if you do.
So the debit would be for the company, and but the shareholder loses that franking.
Correct. So if your franking account had $100 worth of credit in it, suddenly it's now only got $10 worth of... Sorry, it's only got $90 worth of franking credits in it because $10 has just disappeared.
Less that you can distribute to the shareholders.
Yeah, yeah. So when you go to pay your next dividend, you've only got $90 of franking credits instead of 100, which you could have given your shareholders, but now 10 has gone.
And when we overfrank, what happens?
It's a penalty tax. It just goes straight to the tax office. So if you notice, when we looked at that section, it said if you overfrank, it's a tax, but when we looked at the underfranking, it said it's a debit entry in your franking account.
We're not required to know what that penalty tax is.
You'll just do the amount, but that's what we'll do shortly. We'll go and grab a coffee. But it's actually the same as the debit, but it's... If you look at 20... Yeah. If you look at page 852, see how it's got that nice little chart that tells you all you need to know. We need a coffee. But once we've done 3 franking accounts, it's mechanical. Every time you see instalment of tax, credit X amount. Every time you see frank dividend paid, debit X.
Even doing the example from the lecture made it really easy to see.
Yeah. And who was it? Who emailed me during the week? Someone from the class and said, "Oh, I've just done the examples. Oh, on trust. Oh, it's really mechanical, isn't it?" Yeah. Okay, let's go and get a coffee before I die. Oh. Oh, money might be a good idea. I don't suppose they want to give it to me free. Oh, thank you.
Just say I wore, oh, you've got nail polish made, toes chilly blue from how cold it is.
Yeah. Oops. Oh, my goodness.
So I looked at the weather and it said 23 and I was like, oh, that'll be fine.
Well, it will be later.
But right now, no.
It's already out. I don't know why I checked it earlier. You go to, just don't see on my page, go to, go to course, inside it, go to course content, and then there might be, in my grade, just post there, on top. What I did is, in my friend was studying, and then go to tax. Have you seen now? And then go to the course content. And then my grades. And then have you seen the report result?
Yeah, I was talking with a friend and she haven't seen her, so I think she's
Still
them,
not
yeah, all of them.
How'd you go?
Not bad.
Did you do all right in the exam?
The exam,
Did well?
the exam of the tax,
Yeah.
was not the
Pass?
best one, but pass. Yeah.
That's what you care about.
Yeah.
Have you done statistics? I submitted, but my percentage was so high.
How much?
Was like 42%.
Same here.
Yeah.
Don't worry. And I emailed him. That might be because of we didn't do referencing. Could
Yeah.
be. Don't know. But I have copied from no one. So I did everything by myself. So
Yeah, but
I
that
don't worry
happens
about it.
because it's actual, business reports are always like that because it means you've all got the same answer and that's what you want.
Yeah. But also you cannot change like only
Yes, you cut and paste,
Yeah.
which is what they're saying. That comes across that everyone's got the same. So that's what's normal. I've done one and I've got 65%. I freaked and it still went through because that's what it was figured work.
Yeah, you cannot.
And at least I went, well, good, didn't I? So I got the same answer. Everyone else must have the same
And
answer.
actually, I remember because I copied the formula from PowerPoint, but I remember he said that also in the
Yeah, I did.
lecture.
I did same. I just
Did you
did
find it
copy
hard?
and paste.
In the beginning, yeah, and I think I got one question wrong. I got the third question, I got it wrong. But in the end, I was,
Because it's done.
How much was it? How much is every report grade? in this? How much you got
This one,
in simple? If you don't mind.
let me check. I got 15 or something.
15?
Yeah.
Oh, good.
15 something.
Good.
Did you have already?
Yeah, I
Yeah.
already have mine. And it's too low.
Yeah. Because I remember that you were saying to speak with her.
I don't think that will help.
It's pretty good. I'm not saying anything. I don't know. Yeah, statistic. Now we have to do accounting and economics. Economics,
You have to write 4,000 words.
yeah, you guys started.
No, not yet. Have you?
No.
Not even touched.
Not today we want to speak with her. Actually, I don't know much.
Is it possible to talk with Colin regarding our grade?
But if you want to ask her some suggestion or
No, she said practice, do more practice. I went there in consultation hour and then she said practice.
Yeah. Or maybe can't wait to finish everything. I'm so tired.
Should I have whole day up to 7:30?
Class today, yeah.
Up to 7:30.
Yeah, but I'm not sure if I'm staying till I hope.
I wanted to sleep today and wanted to come, but I think
But let's go. Yeah, I wanted to come because if I don't hear this, it's not good. But yesterday I was doing that and now I don't care if it's wrong with the question. I don't care, I just submit. And submitting was 46.
Sorry.
Look at that.
same thing happened to me.
Seriously. And sorry, I'm changing words and everything. And I resubmit. At one point I wrote to the others, how much do you have? Did you submit? No, yet either. I submit.
Everybody got mine.
Everybody got mine. So should be like okay.
Yes, it's good. That's why I didn't go out.
How's your corporate accounting one? How are you going in your group? Is it good?
Yeah. The group, yeah. We're gonna meet today and tomorrow we want to finish.
Have you started the report?
No. Today we're gonna have a look in everything and tomorrow.
You've actually started, you've done the entries and all that?
Yeah.
All of them?
We missed one, the inventory.
Yeah, this is what we're having trouble with.
Yeah, that one we also made. That one we cannot.
Yeah. We're going to go to her class today.
Yeah,
and
after.
And after, in that between,
Yeah.
we're going to speak to her about it because that's got us completely stumped.
Yeah. So. And tomorrow we want to do all day. All day and finish. Also because I cannot take. I took off tomorrow to work. I cannot take.
We did all weekend.
Hmm?
We did all weekend, didn't we?
Yeah, we did.
We did.
The week.
We did from 2 to, I think, 6 on... We came in another day, didn't we?
That was on Monday. Was that for 1 hour or?
4 class. Yeah. 12. We got here at 12. I think 12 till 3. We did 3 hours then.
Yeah.
And then on the last Monday, and then we did Saturday from 2 to 6. And then Sunday from 10:30 to 5:30. And we just still haven't finished.
What we did in the last couple of weeks was like meeting a couple of hours. So to be ready to arrive at one point and have all the
Yeah.
steps ready.
20%? It's really hard. It's a lot of work. It's a lot of work. You think you sit there, oh, that's all we have to enter. But it's not. It's the setting up. It's the...
In fact,
And then we realised we'd made mistakes, so we had to go back.
she's helping a lot.
Sorry?
She's helping a lot. Like all the time we email her, she
Thank
answers.
you.
Yeah. So yeah, today I have to clarify a couple of doubts and then tomorrow.
Right.
Everybody got 15. Let's some others also got 15. Why
15 and what?
out of 20? Most of them had 15 out of 20.
What for?
On this tax report. I got the lowest one.
How did one go in the actual test?
90th?
Yeah. Did everyone pass the actual test?
I think that passing rate was 83 or 86%.
7 or 80 students.
Sorry?
86% passing
Pass.
rate. She mentioned in the black book when I was with you.
Look, just as long as you, at the end, get 50%, you passed. And I don't know what to say. Let's make sure I think this, no. That's the end for this. I can do this.
Mm.
Yeah. At least it's the first one, is the short. The workplace is -12 all the time. It's so cold. Because it's centrally set. So
Oh, okay. We must get on. So let's. Oh, where am I? Where was I?
The dream question is,
I thought it was.
You on top of all your assignments?
Oh,
It's taken quite a
I don't know what all this does. I'm doing capstone,
most
CPA capstone, CPA audit, research project.
started that late last night, just transcribing formulas onto
Like, he was like, he's still doing
Okay.
semester, but he hadn't been lecturing. And then
let's go back into our franking account now that we know how to calculate various things. What was our next one? 1st of October. So it's a cash dividend of 21,
Frank
but it's only franked to 30.
20%.
I can read.
So when it says, received dividend, that's meaning the company's paid it out.
No, no. Another company has paid our company a dividend.
So we just recredited that.
So the cash is 21,000. What would be the maximum franking credit on it?
Do we need to know?
Yeah, because then you've only franked it to 20%.
20% of the 21.
Need to find
The 21,000 is the cash dividend.
899.97.
If it was franked to a maximum,
Which is what we're saying there.
yeah.
It's percentage, the franking percentage is.
So you multiply 21,000 by 4 point.
Would you do 4?
0.41.
What does the question say? It doesn't say that it's come from a BRE, so it'll be a 30%, which means you use the 0.42857. The question would have to tell you,
Yeah,
That-
we can also just do that.
okay, this is a good point.
Just
The question would have to tell you that it's coming from a BRE. A BRE is a 27.5% taxed company. So in this case, just go with it being a 30% taxed company.
Okay, so if it doesn't say, mention that,
Yeah,
you take it as
just
the higher
use,
one.
yeah. At this stage, I'm just trying to get you used to the concept.
Sure. And that'll be like an exam, we'll say.
So if it was 21,000, what's the maximum franking credit?
899.97.
And how did we get that?
21,000 times the 0.428.
So we've received a dividend of 21,000. What would be the maximum franking credit? How did you calculate that?
times 0.4.
Which is?
8,999.97. One more nine.
8999.97.
Yeah.
Okay.
Can we, so in
Oh, it's so close. Just
we can
Yeah.
round it up. Yeah.
now, but it's telling you that's 100%, but it only franked it to 20%. Sharon? Yeah.
20% of that.
20% of this is?
One's, well, basically is $1,800 rounded.
So there's your balance. Now your next dividend. Oh, no.
PAYG. So the 28th of October.
Okay, so 28th of October. What's next? 10th of November. So just keep working on this.
to pay the tax and it was the same amount.
Pay the tax, what are the credits in?
Exactly the same.
Yeah, because it's you paying the tax. It's interesting.
Oh, hello. Could you put me through to Hamish McNair, please? Oh, hi, Hamish. It's Colleen. Hi. Are we still on for that recording this morning? I didn't hear back from you. Oh, no. I just wanted to do one for this week and then all the rest normally on Thursday. No, both. Have you got time today or? I've got a lecture till 11 and by the time, because I'm at the other end of campus. On 11:30 is perfect. Even 11:15 is fine. So where do I come? No. Yeah, down there. Okay. Okay. Great. I'll see you then. Thanks, Hamish. Bye-bye. Now, if you're managing, help your neighbour.
said 1800. So what's the difference with the credit? What we have not received?
Sorry?
So with the, so if we received in then 20%, so we said it's 1800. So we calculate 20% of the maximum.
Yeah.
Yeah, and so won't the difference be the credit or?
No, it's the
that
actual
20%
credit
is-
attached, and they're only attaching 20%.
Alright, so just whatever is attached, that's
Yeah,
what it
yeah.
is, not the,
Yeah.
not given.
Yeah.
Okay.
And so, and then if you look at the one on the 1st of December, it's only franked. So be very careful because it says franked dividend received,
Yeah.
right? But then, when we come to the 15th of Feb, we paid the shareholders. They're from other companies. Yeah, they're from other companies, and it's up to those companies as to what they want to do. If they want to frank them to 20% or 75 or 100 or... Oh, goodness. I'm so cold. If you see something on the news about lecturer's dead body found frozen to death in car, you know why. You know it'll be me. Come to my funeral.
I think I'll be frozen.
You'll be frozen.
Frozen on the way to my car. Down at the other end of the
Oh,
half the car park's closed down and grey parking as well. Well, the small car park and then half of the big car park.
Why is that?
Doing works.
oh, just to make life difficult.
It's good that it's like week 12 or whatever, and a lot of people don't turn up to uni, otherwise there'd be no fit left.
But I like coming in this early.
Yeah, because you get a bag, parking bag.
But it's not, it'd be nice to park there, but I won't have to park right down there, because we don't finish till 7:30 tonight.
Well, yeah, I'm going to move my car at 5:30 up to yellow parking when it's free then, because I have a class in the med building, but I'm not going to pay for yellow parking all day, because that's too expensive. Not as much. When they first changed the system, green parking was capped at $2 a day, and that was a really nice time. And now it's capped at like $7.
We see, it's interesting. We used to have, you just
Not
paid.
anymore.
You just
The
paid
permits,
per
the permits was
Per
like
year.
semester.
Yeah.
Or
permits were
in fact,
amazing.
like we used to pay per year.
I used to pay per year for my.
Okay, do you want to love this? I know it's 30 years ago. $40 a year.
Oh,
$40 a year.
I feel like in 2010 it was still like $200 something a year. It's still pretty good.
Like when you paid the council and got the lift card to bring out the car.
And then I think, so you've got to be careful about what you complain about. So students complained and said, but I don't come in every day. Why should I pay for the whole semester? So then, they said, well, okay, well let's look at it again. You know, so let's look at short-term parking, so now you're going to pay all the time. Look at where we are. You know, we
Except
shouldn't
that
just
it's
say,
fine
shut
when
up
they
about
brought it in and then they're like, oh, it's cheap, and then naturally they hyped it every
Oh, yeah,
single
because
year.
we've given it to that idiot mob. They're not idiots, but you know.
And your staff parking, which used to be the med building, is so nice and close.
sure we don't have to pay for parking.
Oh, yes.
Just to pay very expensive for a reserved day.
$2,800 a year for my parking because I have reserved undercover parking.
My auntie was telling me.
No.
My auntie she works in the exam paper section. She's in charge of everybody here and does graduations as well. And her and like 3 other people carpool together in the morning because of the parking.
Yeah.
So they all just pay a third instead because they don't want to buy a reserve bay because they're not here all year round. There's weeks where they're not, but yeah, they carpool together because it's so expensive.
I know, it's okay. My daughter-in-law works here, so
She's doing good things.
she gets Monday 2 days a week, and I give it to one of the other lecturers another day, and then I come in 2 days a week.
Do you think they would look after the staff, surely?
Sure, it's a
one of the most undervalued
I loved
resources
it
in
when-
universities and stuff.
That's why I'm leaving
I loved it when they brought in one tuition-free week as soon as
next year.
Where?
Just retiring. I'm 62. I will be back.
You really don't see many in your retirement now.
No. Gibby.
No, I'm not. I've got 3 jobs at the moment. I've got this, I've got BDO, and as soon as the Tax Institute knew I dropped 50%, the Tax Institute gave me all this extra work to do. So I worked like a slave.
So you'll stay those other jobs?
Yeah.
Where's the other?
BDO, the accounting firm,
Oh, okay.
in CDFO. So I do the corporate and international tax training. And I do the State Tax Institute. I'm supposed to be on transition to retire.
So does your husband work long hours like you?
Oh, my husband died 2 years ago. So that's all right. No, that's all right. No, he was semi-retired anyway. I started working harder when he retired. He started telling me how to stack the dishwasher. I said, I think you need to go and become a Rottnest Island guide and stay overnight. And he did. So
Did he? How good was that?
it was wonderful because he loved Rottnest.
I do work further going over and on it.
Oh, right, yeah.
And I just, it's just so lovely. It's
Yeah.
just like
Oh,
half
he
lived
just
here and
loved
half
it.
lived here.
And
I
he would
love
go,
it.
he would do like 2 days or 3 days in a row and stay overnight. And I could stack the dishwasher as I liked. So, I fell in lots of people who do that when their husbands retire.
It's like my parents. I work when they come home. It's like,
Oh, my dad used
Yeah,
to
I don't
work.
know how a lot of families do that.
My dad used to
No.
work on a ship and he'd come home after weeks or months and Mum would say, your father's coming home and we're like, God.
it's really hard because you do that. It has to be routine and it's new.
Yeah.
And then all of a sudden you come home and you don't get that everyday life. And then you're going, whoa.
My friend said her life's so weird when I was home and like her life's really out of killing.
All right, how are we going with this? So here's our, am I doing the right one?
I hope not.
Is it that one? Yeah, it's that one, isn't it? Yeah. Okay, so you can see that we've got that dividend received at 20%. We've paid our instalment, we've paid our income tax, then we've received another dividend, only franked to 75. And now here, we've got our dividends that we're paying. So we pay this one, we've franked it in full.
This first February as well.
Sorry? The trust, that's on the 30th of June.
First of February.
I know, but if you look at the section, it says 30th of June. It's very sneaky. It's subsection 2 gives you the date, and the date is 30th of June. Favourite exam question, that one.
If there is trust portion, then we have to automatically think like it will go under 30%.
Sorry, which one's that?
The trust distribution that was actually paid on the 1st of February. Sorry, shall I make that a bit bigger? I can never work out whether it's just me being old and I can't see.
I'll say you don't miss the first effect.
No, you don't show it at the 1st of Feb, you show it at the 30th of June.
Okay, so where it says distribution is 7,500, go back and complete that.
Which one, sorry?
So 1st of Feb, it says distribution of 7,500 received from trust. So that's only just telling you information.
Yeah, it's not even installment.
Hang on, what have I got 5,250?
It's
question 8 we're doing. I think there were questions 7.
Oh, am I?
I think so.
No, I thought it was question 8.
No, you're on the right one.
Yeah, the right one.
Yeah, that's the question 8.
Yeah?
Yes.
But the action question says, 1st of Feb,
Mm-hmm.
distribution of 7,500 received from trust. We actually don't, that's just giving us information, it's not something you have to record.
Yeah.
It included a dividend of 5.
Oh, yeah. So it included a dividend of 5,250.
Yeah, but okay, so you don't include that 7,500?
No, just the dividend, because remember we're only attaching the franking credits.
Okay, so that's what I'm saying, that first bit of information is just giving you the information.
Well, it's telling you that it's come from a trust. Yeah.
You don't act on that, you don't have to write anything.
You act on the dividend that's included in it. Yeah. Now, you can see in this one, first of all, we paid a dividend. Our first dividend was on the 15th of Feb, and we franked it to 100%. 10. What time do we finish? 11. Okay, we've got time. Then we paid a dividend on the 1st of June. Now, you see how we have to do this in two hits. First, there's our dividend, which we franked to 45%. Then we've got an under-franking.
Just being sneaky.
So this is the this is the amount.
If you want another franking.
This is where the exam goes. I think this is where we have to do it in the exam.
Yeah, it's really interesting because you know when last week when we did trusts and we end up with these distributions to beneficiaries that are taxed at 45%, and one of the guys at BDO does marking for us, and he says, "But Colleen, no one would do this in practice." I said, "Yes, I know, Chris, but I've got to put it in the exam so I know that you know that this is the consequence, and therefore when you go to work, you won't do this." And he says, "But it's just impractical. No one would ever do this." It's just for the purpose of the exam.
So
Right.
if you underfrank,
Yeah.
you still have to put that underfranking bit in.
As a separate bit, because this is where it gets removed from the franking account. This bit here is what takes it out of the franking account.
Yeah, but they don't get that.
No, because, see, they'll get this one,
Yeah,
right? The shareholders will get this one, okay? But they won't get this one.
but the tax gets.
It doesn't even go to the tax, it's just, it's been paid, right?
Why would they do that?
They wouldn't. That's what I'm saying. This is an integrity measure that says, if you do, this is what's going to happen. And, well, you're not paying it, you're just losing it, right? And so, in reality, you wouldn't do it. You know, you would say, like when they set off to pay their first dividend, they'll say, okay, we think we're going to get X number of credits coming in, we're going to pay instalments, blah, blah, blah. So we think we can frank it to 75%. Okay? But you make that decision based on the fact that you know if you pay another dividend, you've also got to frank it to 75%.
So really, you are going to, there's no benefit of unfranking.
No.
It only just disadvantages the shareholders.
Yeah. And, I mean, your overseas shareholders might be happy, but then because there'll be withholding tax at maybe 15%, which they can use overseas. But unless you've actually got all these different categories and things, you're sort of pretty well stuck with paying it, and your other shareholders won't be happy.
No, and then you'll lose them.
Yeah. But, as I said, there is, which we're not doing, but there is a concession for private companies to decide on the franking percentage within 4 months of the end of the year.
Oh, so they can go back and do it.
Yeah, so they actually will just go back at the end of the year and say, oh, look, we paid 3 dividends this is how many franking credits we had. Okay, we'll make it X.
I struggle sometimes in our corporate accounting unit. We were doing stuff in Xero, and I didn't like it because I couldn't get into the back end, which is how I got into the. But I was trying to do it theoretically in that, and I kept being like, but that's not how you do it in real life. Because it's what I sit there doing those accounts all day long.
Yeah.
It was so hard to put myself back into theoretical mindset. So I was like, you wouldn't do that.
I was talking to Joanne yesterday from our said, you're going to audit.
Yeah, because I applied for audit at first. That was my first stream because I applied for them before it. But then I was speaking to John at work and he said I started in audit then transferred to tax and it was a really good way for me to get in and learn stuff and I was like, okay, cool. He was like, go in and do that and then move to tax and he said you'll get a better understanding.
Oh, Joanne said that to me.
Yeah.
Oh my goodness, no, she's very good at tax.
That's why I was speaking to John. And Jono said, do audit and then transfer to tax. So I'm like, okay, cool. My parents were unimpressed I wasn't going in first because they were like, but we want you to do our stuff. And I was like, you're the most typical parents ever. But yeah, so going in mid-year where they said you'll probably be a bit useless, but probably not as useless as you'd like to be, and you'll be working a lot of hours. And I went,
Oh yeah, you're going into busy season. Oh my God.
and I was like, oh, I should have gone into tax and skipped the busy season.
You should follow, what's it called, the Big Four accountant or whatever on Instagram. They post all this. They're obviously all auditors.
I follow on Reddit. I follow the accounting one, and there's heaps of.
Yeah.
And there was a really funny picture. I'll show you. To do with order. I think it's my
All
favourite.
done. Where are they going? Oh, you've done it. Oh, good. Easy, isn't it?
Yeah.
Do you know, it is easy because, think about this, every single time you see pay-as-you-go instalment, what is it, Ty? What's an instalment? Debit or a credit? An instalment? What's an instalment? Debit or a credit? Credit. 1 mark. Right? So you've got 4 instalments, that's 4 marks. If you've got tax payable, 1 mark. 5 marks now. Or you get a refund, it's a debit. You only have to do them. You can see, can't you? It's only so many times that you do it. Oh, look, here's an instalment, it's a credit. Here's an instalment, it's a credit. Here's tax payable, it's a credit. And you're just racking up the marks. So when you see, if you see a franking account in the exam, you send me messages of love and devotion and say, thank you, Colleen, for our franking account, because it's almost, if you've done them in the past, it's like a guaranteed 12 marks. I should just be able to look at your final figure.
So is this like when your client integrated account that you look at online? That's essentially.
Okay, so we've done this one now. Now, the thing with, see, this is a lovely little franking account here, because we've ended the year in credit, and so next year we will open with that credit. Remember I said to you that it's okay to go into deficit during the year in anticipation of paying more credits during the year. But what happens if you get it wrong? What happens if you overfrank your dividends? Not overfrank. What happens if you frank your dividends, you go into deficit during the year because you think, oh, I'll be paying some instalments, I'll be getting some dividends or whatever, and that doesn't happen, right? So you finish the year and you're in deficit. If you finish the year in deficit, then you pay franking deficits tax. And it's simply the amount of tax that you're in deficit by. Because what you're saying is, oh, hang on, I've given all these credits to my shareholders, which the shareholders are happy about, right? But I haven't actually paid the tax. As a company, I haven't paid the tax. Right? So then, at the end of the year, I thought we did one that we finished in deficit. Anyway, but, so you might think, oh yeah, well, you know what, Colleen, big deal, because, hey, Commissioner's happy, he's collected his tax, you know, shareholders are happy, but, and we don't really do it here, but in practice there's a penalty for doing that. And the penalty is that you can't claim 30% of that franking deficit tax in calculating your tax for that year. So it's a penalty, again, another integrity provision. So with all these, what they're doing is they're putting in rules that say, if you get it wrong, we will penalise you. But if you get it right, everything's okay. You know, you don't lose any of your tax payable, you don't lose your franking credits, all that sort of stuff. So what it's doing is it's putting these rules around you and saying, if you sit in here, everything's okay. If you move out of it, then there's some sort of penalty. So again, we teach you the penalties, we make you work the penalties, because when you go to work, if you are in the business and the directors come to you and say, Tai, we want to pay some dividends, how many franking credits can we attach? Right? And you have to say, well, I'm looking at the figures, we can do this. Bear in mind, though, we'll be paying some more instalments. Bear in mind, we've got shares in these companies, they always pay us franked dividends. So we can actually go a bit, we can give more credits. We can frank to 100%, even though we've only got these many credits right now. By the end of the year, we'll have these many credits. So we can, you know, we can frank it fully at the moment. Okay?
So can I ask you, so that it doesn't happen and you don't cop a penalty, do you find people, companies quite, like, underestimate and make sure that they don't do 100% and they do...
I think it depends on the companies. With a lot of companies that don't have a lot of non-taxable sort of income or big deductions that can skew things, they'll probably frank to 100% because they've usually got enough credits. The problem arises when you've got income that's not taxed or you've got big deductions, like you've got big Division 43 deductions, business capital business deductions, you know, the 20%, or a lot of overseas income that's not going to be, or you've got the foreign tax credits or it's nain income, and that's when it becomes very difficult.
Because you can see that people would do, like, say, 75, and then at the end they've got heaps of money left over. So
It's not the money, it's the credits.
Okay.
Yeah. It all hinges on the credits.
And yes, they're pressured by superannuation funds and retirees saying we want that credit.
Yeah.
Yeah, you can see that.
So you all may become too conservative because you get under pressure for that as well.
Yeah, because if you've got all this over,
Yeah.
then you...
So if you're paying your shareholders 75% franked dividends. Hello. Sorry. If you're paying your shareholders 75% franked dividends and you finish the year and you've still got, you know, $2 million worth of credits, your shareholders are not going to be happy.
Yeah.
Because they're saying you should have franked it to maybe to 80% or 85% and given us the credits. On the other hand, sometimes companies like to keep the credits because maybe they know that there's some of that untaxed income coming through, and so they can sort of even out the flow of franking credits. So.
If you don't have that overseas income or all those big deductions, some companies get caught and just have franking credits they can never get rid of.
Yeah.
Well, that's what I'm saying. Because
And
at
when-
the start of the year, you'd be like, oh, financial year,
Yeah.
I've got heaps. So you frank it at high, and then it's all of a sudden you can't do that every time, and you'll get a penalty.
Yeah.
So is it easier for public companies if they pay 2 dividends a year and they can then set it?
Yeah, they've got a much better grasp. And if you look at, I'm trying to think of some of the ones that I've seen.
Wouldn't it be better for a public, because they can work it out and go, right, well, this is what we got, and you
They-
can run instalment, so you're not going to get
You
a
know, because
penalty.
they pay an interim dividend.
They pay an interim dividend and then a final dividend.
They can
A
change
public,
it
a
as
private,
Public.
public.
yeah,
Mm.
but a private one only has to do it once.
Well, what you'll find is they'll probably pay a few dividends during the year, sometimes twice. Again, it depends on the size, it depends on the shareholding. You know, if it's just mum and dad as the two shareholders, two directors, or do we form a private company, the people in our group. Now, obviously, we've all got different needs, so we may not be happy saying, one dividend a year. You know, we might say we'd prefer quarterly dividends. So it would all depend, on who your shareholders are. Okay, now what I want to do is finish with that, get you to please do some in your own time, because honestly, they are so mechanical. Okay?
So can we quickly see underneath that what you did with the company?
Oh, so then
Taxable income?
okay, hold on. Let's go back to the question. It then says, assuming taxable income of 240 in the current year, what is the net tax payable? Actually, that's wrong. It should be BRE. If Giggles is not SBE, change that to not BRE. Come back in here. So on 240, your tax is at 30%. And then we had franking credits received, from the dividends. And then these are our pay-as-you-go instalments that we paid, which related to that year. Because remember, you pay your instalments for the 30th of June 2019, you pay your first instalment in October, which is for the September quarter. Yeah? And then in February, you pay for the December quarter, because you get an extra month with Christmas and stuff.
Yep.
And then in April, you pay for the March quarter. And then you pay in July of the next year the fourth instalment, which is the June quarter. So when I come to work out the tax payable for 2019, I take this instalment, this one, and that one.
Because you take that one, July.
Because it relates to the tax, your instalment for the June quarter.
So wouldn't you have taken it for July,
That was last year. So when here in July 2018, you were paying for the June 18 quarter. So that relates
So you
back.
basically have to wait. You can't do this until after.
Well, you don't ever do your tax return till sometime after your company return.
So you just wait. You do it once everything's been paid.
Yeah. No one, well, I don't know of many companies that would settle down on the 1st of July to do their tax return.
You do them up until May, isn't it?
Oh yeah, and then if you actually pay the tax, you can extend it out a bit later.
Tax agents can pay the things
I know, I'm just getting mine done.
now. It needs
15th
to be stretched out further.
15th of May is approaching. Okay, so let's leave franking accounts. And honestly, if you do some franking accounts tonight, tomorrow, you'll have them. They'll just be in your head because they're mechanical. Okay, send me an email when you've done them. Yes, yes. Send me an email saying I've done question X and Y. All right. Now let's go back and talk about companies generally. So the first thing is, you know, a company is this artificial creation that doesn't exist. The beauty of a company is that once you buy and pay for your shares, well, this was the original situation, you had no further liability in relation to the expenses of the company. Now, it's because of that that we have a lot of the law that we have to study now. So what we've got is, here's our company, and here are our shareholders. So these are the shareholders, A, B, and C. Now, originally, the benefit of a company was the company would then operate. The company would bring in money, spend money, borrow money, enter into leases, all that sort of thing. And once you'd paid, if you had $1 share, once you paid your $1, that was the end of it. Now, of course, what we're seeing is that in smaller companies, those shareholders were often the directors, and the directors are running the company, and often they'd run it into the ground, and then they'd write off all these debts, and then they just start a new company. So now, as a director, you have got various, what's the word? Not quite. Like you can have to pay as a director some of those expenses, and I think they'll come after you for superannuation and that sort of thing. There's a word, can't think of it. The other thing is that if we go back in time, this is what used to happen. The company would end up with $1 million loss. A and B started this company, they put their money in, and then the company didn't make any money. And they kept putting more and more money in, and it's got this loss. And after a while, they said, oh, we don't want to keep losing money. But C and D, sitting over here, either had a chunk of money in the bank or a very successful business. Remember, this is all pre-capital gains tax. So what would happen is A and B would sell their shares to C and D. Now remember, the loss sits with the company, not with the shareholders. Ty? Yeah? Remember with partnerships, who got the loss? The partners got the loss. Remember? Partnership made a loss, $10,000. We gave 5 to A and 5 to B. Remember that? Ty. It's because you haven't done any partnership questions. Right? So the loss passed through to the partners. But in a company, the loss sits in the company until the company makes a profit. So what happens is C and D buy the shares and then they move their very successful business into the company. Now their business is still making money, and look, it's got $1 million worth of losses to offset. Okay? A and B are happy because they got paid a bit of money. They got back a little bit of money, right? C and D are really happy because they're making all this money and not paying any tax. And the only person who's not happy is the commissioner. So, we have rules which apply about the losses in a company. And the rules are this. The first rule is if you want to offset that loss, you must meet the continuity of ownership test, usually just called COT. And it says more than 50%. See, more than, it's not more than or equal to, more than 50% of the people who owned the same shares from the start of the loss year, so say that's year 1, until the end of the year in which the loss was recouped. Right? So you've got loss, and this year you've got income. So now you want to offset that loss, and maybe if you've got sufficient income, you might want to offset that loss as well. Yeah? Now, it says from the start, from the 1st of July of year 1 to the 30th of June of year 3, the same shares must be held by more than 50% of the shareholders. And even that law changed relatively recently. I'll show you why. So first test is continuity of ownership. So you have to look who owned the shares. So in this case, you had A and B. A and B were the shareholders here. A and B were the shareholders here. But C and D were the shareholders here. And you failed your continuity of ownership test. Jaron, you're looking very strangely.
I'm a really small team, but I've worked it out there.
Okay?
Yep.
Ty? Make sense? Anwala? Shamila? Both? I'm getting these very blank looks, you know? I'm getting no enlightenment on your faces. I want enlightenment. Now, not only... Okay, let me go back a step. When this law was first brought in, it was simply that the same shareholders had to own more than 50% of the shares. So here was how you got around it. If you had A, B, C, and D as your original shareholders, and A held 30%, B held 25%, C held 20, what am I up to? 56, 75, 25%. Okay? All that had to happen was, remember, we've got to have more than 50%. So, A and B together have got more than 55%, more than 50%. So, the company's running at a loss. They think, oh, we want to get out. What used to happen was A would buy 50% of the shares. B, now knowing on his or her own, A doesn't have more than 50%. So we need B, or C or D, wouldn't matter. So B sits in there with one share. And now E has got 49% of the shares. And you'd say, oh look, together they had 55, together they've got 51, so tick, tick, we can claim the loss. Jaron?
What's the logic of combining those shareholders? Sorry?
Well, the section says, we're not looking at the section. The section says that shareholders who between them hold more than 50%. So it doesn't have to be one shareholder, okay? It can be any number. Right. So it's never going to work with A because the most A's ever had is 30. So if we forgot about everybody else, the test won't be met. But we could put A and B together. They've got more than 50. And here they've got more than 50.
Which means that A and B could then claim the losses as well?
No, the company can claim the loss.
So this is what it's all about. It's
The company claiming the loss.
all about losses.
Yeah.
That's what we're talking about.
Yeah.
Because I'm just really.
Okay.
So we're just concerned about claiming losses. And
Yeah,
that's
because remember what happened here? The company had $1 million loss. C and D had a profitable business. What do they want to do? They want to bring the business in here and offset the profit against that loss so that, well, who owns the company? C and D?
C and D do now.
Yeah. And they don't have to pay tax on the profit.
So where's A and B gone?
They've sold.
So, okay.
They've just sold their shares.
So now C and D
Own the company.
at a loss of $1 million.
And sitting in the company is $1 million loss.
So then they can.
Right? So they bring their profitable business in. A profitable business makes a profit and offsets the loss.
Okay.
So maybe it's making, well, let's say it's making $750,000 profit in that year. It's got that $1 million loss, so it pays no tax.
Okay. So you're saying when C and D took over, was it in year one or was it year?
No, here. If it was here, it wouldn't matter because they took the loss.
They took the loss until it starts making a profit.
Yeah, but what's happened is A and B owned the shares here and it made a loss. The company made a loss.
Yep.
A and B owned the shares in year 2 and the company made a loss. C and D buy the shares in the company in year 3.
They can't claim that loss.
And the company can't claim the loss under the continuity of ownership test.
Okay. But if they didn't make a profit in year 3 and they've taken over in year...
That's fine. The problem then arises when they want to recoup the loss.
Yeah, so when it's...
But here, so what it's going to say is, okay, remember, it's from the start of the loss year to the end of the recoupment year. And what we're going to find is that if C and D took over here and there was a loss, but when we come to here to offset, who are the owners? C and D. Who were the owners here? A and B.
So you can't...
So you can't offset that loss. You might be able to offset that loss.
So who are the owners when the loss happened? That's what.
Yeah, so the section says you must have continuity of ownership from the start of the loss year to the end of the recoupment year. Right? The same people must own more than 50% of the same shares.
So if it was like 10 years down the track before, like C and D took over in year 3,
Yeah,
and 10 years down the track, then it started making a profit,
yeah.
you can't write off any of those other ones.
Well, you can't write off
The
these.
first 3 years, no.
Well, you might be able to if they took over on the 1st of July.
Yeah.
We're still creating losses, claim those losses.
When did the loss they
Okay, so
they
there's
got
one...
So pretty much only when they made loss themselves while they were being owned, then they can claim those.
Yeah, they can only claim it when they start making
Yeah.
it. So those losses that you
Are gone.
are gone. Too bad.
Yep, yep.
So A and B loss.
Well, we'll see. There is a fallback position. Okay? Now, the new rule is here that not only must you, because you can see under this, it would be very easy to still pass the test. Under the new rule, you must not only own the shares, but you must own the same shares. You must own more than 50% of the same shares. So now, under the new rules, we would say, which are the same shares that A has held all the way through? And it's only 30%, isn't it? So now, and how many shares has B owned all the way through? 1. And so now it's only 31%, and therefore you failed the test. So now, to meet the continuity of ownership test, you must own more than 50% of the same shares. Okay? It's an integrity measure because the revenue was being lost up here. Now, if you fail the first test, the continuity of ownership, you can fall back into the same business test. And what that says is, at the point at which you failed COT, what was the business you were running at that point? And are you now running exactly the same business? Now, okay, this was a very blatant use of the loss provisions. And in fact, when I was a young assessor at the tax office, I can remember older people saying to me that there used to be advertisements in the paper, lost company wanted. Why would you want a lost company? Because it's got losses and you can transfer your successful business into it, right? And so that was the mischief, right? This was the mischief. The solution is same people, more than 50% of the same people owning the same shares all the way through. Okay, great. Lovely. If you fail that test, providing you are carrying on the same business, you can offset the losses. So what it's saying is, obviously, someone buys into a loss-making business and says, I can turn it around, and proceeds to make changes and that sort of thing. But it has to be the same business. And there have been a whole heap of cases on what is the same business. So, I think it's Chalora Motors. It was selling car spare parts, and was making a loss. It changed so that it was still selling spare parts, but it was a different brand and that sort of thing, and the court said it's not the same business. Now, it's a bit difficult, really, when you think about it, because if you buy a loss-making business, you're going to want to make changes, aren't you? It's making a loss the way it's running, so you're going to want to make changes. The question is, how extensive are those changes? Have they actually changed the nature of the business? Now, in reality, this is very difficult. In our cases, they're going to be very simple. So if you have a look at question 1 now, please.
So in reality, the onus of proving this sameness is hard?
Yes. Yeah. Because, as I say, if you went in and bought a loss-making business, you would want to start making changes. So the question is, are you making just sort of slight changes, or are you actually changing the nature of the business? And in Chalora Motors, the court held that actually changing brands, so if you were selling VW and now you're selling Toyota, it wasn't the same business. So have a look at this question now and see what you think of the answer. There's some very interesting aspects of this. So we do a lot of mining, and if you made your losses of course, in exploration, and now you're mining, is it the same business? Because now you're mining. Your losses came from exploration. And you've invariably failed COT as new investors have come into the business.
It's quite common to lose money when you...
Of course you're losing money,
Yeah,
not
but
making
you're not
anything
making
in exploration.
Yeah. It's been quite frustrating to...
And what if you've done everything and you're looking for gold and then you start mining lithium? You probably wouldn't, I'm sure it's all different ground, but
Yeah.
it's the same business. But it's the same business. We are a gold mining company.
No, your money's...
Oh, hang on, sorry, no, actually we're going to mine lithium. It's the same business.
I was thinking the same thing for a retailer. Is the factor a retailer enough? Or do you have to be retailing the same products?
Yeah. So how much do you change? You were wholesale, now you've gone retail as well.
Is that the same as?
So is an expansion of services changing?
Yeah, what about those big organisations like Coke who's got so many different types of companies and they can...
Big companies are a little bit different. They've got different continuity of ownership tests, so they're probably more likely to pass on continuity of ownership and won't look at the same business.
So do you have to fall back on case law quite a bit to establish where
You
think
might, yeah. If you failed COT, then you would come into SBT and try and prove your case. We won't be examining it, but it's just, when I say just, a few months ago, the similar business test passed Parliament. It's not in our notes. And it's part of the new technology innovation, and it's sort of saying if you use like the assets of the original business and that sort of thing, then maybe it's a similar business. I'm not looking forward to writing questions on that one, but anyway, we don't have to worry about it. So make sure you pass this year. All will be well. All will be well. Okay, come on you lot. We've got 2 minutes left. So we've got travel agency, hotel, motel. We've got A and B held 100 shares. Now we've expanded. Okay? And in the current year, we've got a capital gain. So we've made a loss of $10,000 here. So the question is, did more than 50% of the same people own the same shares from the start of year 1 to the end of year 3? So A and B owned 100%. A and B owned
50%? No,
2 out of about 45%, 40%. And then they only own 200 out of 900, whatever that works out to. So they've failed COT, haven't they? Rachel? Yes. Yeah? Shamila? Yeah? Okay.
So they failed COT as of period 2.
No. If we want to offset the loss of year 1 in year 3,
Oh, year 3.
right? Year 3 is our profit year.
Right. So that's
So see in your question, it says, in 30th of June, the company reported a taxable income of $25,000. Okay? So the question is, can we offset that $10,000 loss from this year against the $25,000 income in year 3? And the test is, did A and B, who were the 2 original shareholders, did they own more than 50% of the shares from the start of year 1 to the end of year 3? Joe?
Yep, I'm with you.
No, they didn't, did they? They failed.
So they played the same business one as well.
Pardon?
They played the same business one.
So then we say, well, did they have the same business? No, because of course at this stage they've brought someone new in, right? Was it the same business? Well, no, because the business now is something else. So they failed COT and they failed SBT. So then we look over here and we say, did the same people own more than 50% of the shares there and more than 50% of the shares here?
So we do that after those two tests.
Sorry?
Sorry, what was the question then?
The question is, now we've got a loss of 20,000 in this year. Did the same people who own more than 50% of the shares in this year own more than 50% of the shares all the way through to this year?
No.
Still Andrew.
This person did,
Yeah.
seeded.
Yeah.
You can put 3 taxpayers together, 3 shareholders together.
Ah, I forget the combination thing.
I was looking back there.
So they've got 100
Yeah, I was looking at them on their own.
and they've got 500 out of 900.
So they've got 5.
They've got 100% here, A, B and C, and A, B and C have got 500 out of 900 shares.
They can offset their previous year.
So this loss can be offset in this year. That loss can't.
Okay, so even though it's on the same business.
No, same business is a fallback test. The first test is continuity of ownership. You don't have to meet both tests, you only have to meet one.
Yeah.
And we met COT. The first test is COT. First test. You meet this one, you're home. And we met it. You're trying to make them meet the second test. You don't need to meet same business test if you meet COT.
But I thought you said that it had to be from the start
Of the loss year?
but that's lost.
No, we're talking about this year.
Split up the losses now.
Okay.
So we've lost that.
Okay, so you start.
That's gone.
So you start at year 1 first and do that.
Yeah.
It doesn't work, so then you start at year 2.
So now we've got a loss here. We apply the rule again.
Okay.
Did the same people own more than 50% of the same shares from the start of the prior year to the 30th of June of the current year?
Okay. I was taking it as that question saying, well, you have to take it from year 1 to
No, because there's a loss in this year,
as well. Okay.
right? So the question says 10,000 loss there, 20,000 loss here.
So we can
You
claim
take
the
one
20.
at a time.
Yeah, so you look at the loss of each year separately. You don't bundle them all up together. Okay? All right, we better leave it there. What I might do is next week, I think we'll finish up with a few more little questions. We might do these, and then we'll do GST. And GST is our last topic. And then we'll have a week of revision. Okay, and I'll go back and have a look at all those. I'll have a look at those lectures. Oh, yes, sorry, who came in late?
Yeah.
Yeah. Who else came in? Nevada, you came in. Was that all? That was all, wasn't it? Sharon? Yeah. This is
what my friend sent me once. We both got our jobs.
What is it? I can't
Oh.
see.
Just says like it's in a thing and it just says find fraud, like in a search in PowerPoint.
Oh, yeah,
Yeah, because you know that's all you've done starting.
Yeah, yeah, and now you've got to do
Now we've
the
actually got to do it. Yeah.
the real...
The real work, yeah.
If you're around, yeah. Sounds strange, like we're about to actually work. Just having someone around, they're not doing the same stuff.
See, Manuela?
Feel like I'm not.
Oh my God, I can do no questions now.
Just do some franking accounts, and honestly, they are so easy because every instalment is a credit. Every tax payable is a credit. Every franking credit received is a credit.
Everything's a credit, but
When you pay, it's a debit, and then the only
you
thing
receive a refund.
is and under franking.
Yeah.
Yeah, and honestly, all the questions are like that. There's an over franking and under franking. So just do them, and it's so mechanical.
Okay, so you said you want us to email you and tell you
Yeah,
you've done
just
it.
tell me you've done
Or
it.
which one?
Anyone.
What do you want us to do?
She just wants to be highlighted that you're being diligent.
Yeah, I just want you to tell me
She
that I've
wants to
done.
revel in your
Yeah, because that was it. You sent it to me. You said, "Oh, yeah, it's really mechanical, isn't it?" And I said, "Yeah, just follow the flow chart." And it is, isn't it? And if you follow the flow chart, you can't go wrong. The problem is that people get a bit cocky after a while, and they think, "Oh, I don't need the flow chart," and then because remember I'm marking you on the sections. Yeah. So if you follow the flow chart, you have to get the sections right. If you don't, you end up just
That's
sort of
in trust, isn't it?
in trusts, yeah. So just go through.
No, it's not actually. It's easy for you.
Okay. All right, everyone. See you. Goodbye.
Hey, if I
Emma, Kyron. Kim's not here. Daniel's here. Hang on. Dia's not here. Jacob's not here. Jose's here. Briar, Scott. 2, 3, 4, 5, 6, 7, 8, 9, 10 of you. Emma? Yes.
I think you might like.
Briar. What's that?
I thought you might like the accent.
Yeah,